Track 1. Welcome to Contractor State License Services Law and Business Review for the California State Contractor's License Law and Business Exam. During this presentation, we will cover the important business, accounting, and legal concepts that you need to understand not only to pass your test, but to become a successful contractor and business person. The best way to follow along with this presentation is to have in front of you a series of slides and diagrams that we call the law outline. You will find the law outline in your home study book behind a tab labeled Outline. During the presentation, we will reference slides by their titles rather than by page numbers. Track 2. We always like to start off on a positive note, so let's start on the slide titled When You Pass, and let's go through it step by step. First of all, what do you do when you pass the state exam? You will have to decide at this time to either activate or inactivate your license. As you notice, in either case, you will need to pay the state license fee. Your state license fee must be in the form of a check or money order made out to the Contractor State License Board. You cannot pay for this in cash, either to us or to the board. Now, you may be thinking, well, I've already paid this fee. But the fee you paid when you submitted your application was for the privilege of taking the state exam. It was the exam fee. Your state license fee is for the first 2 years of your license registration, which, by the way, you must renew every 2 years. If you decide to activate your license, you will need to obtain a surety bond. We can assist you with this. We use the largest, most reputable bonding company, which, by the way, happens to be one of the least expensive that we have found in our 25 years of experience. Surety bonding can be done at any of our locations statewide. It is very important that you make the decision to activate or inactivate your license within a 90-day period of passing your exam. That's 90-day period of passing your exam. Otherwise, you will be faced with having to refile later on. After having gone through this once, you certainly do not want to go through it a second time. So now follow along with the steps on the slide titled When You Pass, and we'll go through what you need to do when you get the passing letter from the state board. You will notice at the top of your passing letter there will be a request for bond and fee. When the state asks you for more money, you know you've passed your state exam. Take your passing letter along with 2 checks or money orders to our nearest school location, and we will take care of the rest with you. Your bond fee may be paid by credit card. The 2 checks are for the license fee to the registrar of contractors that will cover the first 2 years of your license, and then a check to the bonding company. Since your license will be for a 2-year period, we recommend you purchase a 1-year bond. After your first year in business, you'll have a better idea of where you and your business are going. Later on, you may be required to take out additional bonds on certain large jobs, such as government jobs. These particular bonds are called performance or payment bonds. The performance bond guarantees that you will perform the job, thus the name performance bond. The payment bond guarantees that you will pay your employees, suppliers, and subcontractors. Thus, the name payment bond. If these are required, any one of our school locations can assist you. If the job is for $100,000 or more, and the customer requires a payment bond, you will need to get a $100,000 performance and possibly a payment bond. These bonds may require a financial statement or a track record. So check first to be sure that you are bondable for these amounts before you take that job. Continuing on with the slide titled When You Pass, you will note that once you have obtained your license, you will need to renew it 2 years from the end of the month when your license was issued. Assuming you sent your bond license fee on January 1st and the license was issued on January 15th, your license would need to be renewed 2 years from January 31st. Every 2 years, just before that date, you will receive a renewal form in the mail that will tell you that you must renew your license, either active or inactive, again. Your renewal will always be every 2 years at the end of the month in which you received your license. Now, if you should change your address, you need to notify the contractor's license board immediately, because they send these renewal forms to the address that they have for you on file in Sacramento. And if you have moved, the mail is not forwarded, and you may risk an expiration of your license. If your license expires, you will then be contracting without a license. You will also need to pay a delinquency fee if you do not renew your license in a timely manner. Track 3. Turn now to the slide titled Types of Businesses, where we will cover some important aspects of this subject of deciding what type of business you plan to use. One of the first decisions you will have to make as a licensed contractor is what name will you call your business? It's very important what name you choose, because sometimes these names make a difference on whether or not you get a bid. Customers can be attracted to or turned off by particular names, so give some careful thought to how you would like to name your business. The best time to choose a name is when you submit your application, as many of you have already done. The next best time to do it is when you pay your bond and license fee. As you notice on the slide titled Types of Businesses, there are 3 main types of businesses that can be formed in California. They are sole owner, partnership, or corporation. When you file your application, you were asked this question: which type of business do you plan to operate? It is very important that you notify the board as to which type of business you are applying for a license. If you decide to change that method or style, you will need to file a new application, as each business type needs its own license number. Remember that the Contractor's License Board issues licenses only to businesses, not to individuals, unless they are one in the same. For example, if you start out as a sole ownership business, a sole proprietor business, and you file your name as John Jones, the state will assume that John Jones is the name of the business, unless you otherwise notify them. You may at some point along the way decide to go into a partnership, like we have noted on this slide titled Types of Businesses. Mr. Jones went into partnership with Mr. Smith and they called their business Jones and Smith Electric. They may later decide to incorporate themselves and call themselves J&S Incorporated. In each step, or in each case, they had to file a new application to obtain a new license number. To avoid having to make these changes, which require new applications and new fees, we urge you to make this decision at the beginning of your application process so you can avoid submitting new applications and paying additional fees. There are exceptions to this, such as when you form a corporation and establish a fictitious name for your company, also known as a DBA, or doing business as. Contractor State License Services provides incorporation and doing business as services. If you have questions about incorporation and DBAs, please contact any one of our locations, and we will be pleased to discuss incorporation and DBAs more fully. Track 4. The next step in getting a contractor's license is to indicate to the state who will be qualifying this business for a license. There are many different types of qualifiers. These are listed on the slide titled Qualifier. In the first instance, John Jones is acting as his own qualifier, as the owner of the business, the sole owner. In the second case, John Jones and Mr. Smith are in a partnership, and either Mr. Jones or Mr. Smith or one of the partners would be the qualifier for the license. In the third and last case, we see a corporation. With a corporation, it would be one of the officers or an employee of the corporation. The officer of the corporation qualifying the business for a contractor's license is called the RMO, a responsible managing officer. The officer is responsible for the operations of the company as well as managing each of the projects that the corporation takes on. Any one of these businesses, sole ownership, partnership, or corporation, can also hire a responsible managing employee, an RME. This person acts as the qualifier for the company, and as long as this responsible managing employee works for the company, this company can maintain a contractor's license. But once the responsible managing employee leaves the company is given 90 days, 90 days to replace that individual. If they cannot within those 90 days, they then lose their license. A common question many people ask at this point is whether more than one license can be held. It is very common for a sole owner to set up two businesses, one union shop and one non-union shop, for example. In this case, the owner would have to apply for two separate licenses with two separate numbers, with two separate bonds. A partnership and corporation could be set up at the same time, all qualified by the same person, as long as the qualifying person meets the 20% rule, which is that they must own at least 20% of each company for which they intend to be the qualifier. If Mr. Jones owned 100% of a business, he could qualify another company for a license. He could turn around and become a 50% partner with Mr. Smith. and be able to qualify that partnership for a license. He then could turn around and qualify a corporation, assuming he owns at least 20% of that corporation. So it would be possible in this case that he could qualify all three businesses for a license at the same time. Sometime in your career, you may be approached by someone who will ask you to become their RME, their responsible managing employee. Think carefully before you decide to do something like this, because it will mean that you will need to give up your own license. Secondly, you will need to work for this individual for at least 30 hours per week, be responsible, and manage all of his projects. So now you're back to where you started. You're an employee again. If you are ever given this decision, try to convince the person that you would like at least 20% of his company. This way, you will be allowed not only to hold your licenses, but also qualify him for a license by making you a 20% owner of the company. The other alternative is to ask for a lot of money because, money talks. Now, keep in mind, there is a difference between the number of licenses for which one may serve as a qualifier and the number of classifications one may add to a license. We'll discuss this later in more detail. Track 5. Now that you are a licensed contractor and running your own business, you will have more decisions to make. On the slide titled Accounting Methods, there are a couple of concepts we would like for you to understand. Number one is the difference between the cash basis method of accounting and the accrual basis method of accounting. When you start your business, one of the first things you will need to discuss with your accountant is which method of accounting is best for you. Most of you will decide to use the cash basis of accounting. This method tends to be the simplest and easiest in which to keep the company records. We assume that most of you who are already in business probably are using the cash method. Every time a dollar comes out of your pocket, you make a notation in your books. Every time a dollar goes into your pocket, you make a notation in your books. This method is very easy to keep track of. The accrual basis, on the other hand, is a more sophisticated way of keeping track of your business transactions. Every time you complete a job and you've earned money, you write it down in your book. Every time you purchase supplies at the store, you write it down. This doesn't mean that you've paid for it, or in the case of a sale, that you have actually received the cash. It just means that you have recorded it because you have completed the process. The reason for keeping this kind of bookkeeping in your business is that at the end of the month, you will know how much money you've earned and how much money you have spent. Obviously, the goal is to spend less than you have earned. If you have ever had experience with credit cards, you'll understand how important it is to live within your budget. Now, the accrual method is more sophisticated and more complicated. So, on the state exam, if the state were to ask you which is the best method, obviously, you're going to answer the question the way the state would like you to keep your books, and that would be the accrual basis of accounting. The slide titled Sources of Capital looks at sources of capital. Everybody likes to talk about money, so let's talk about capital. And we're not talking about Sacramento here. We're talking about money capital. Where are you going to get the money to start your business? In most cases, it's very easy to start a construction company because it doesn't take a lot of money. First of all, if you have a truck and you have some tools and equipment and a desire to make some money, you can be in business. Usually that's all it takes. But you are limited in the amount of jobs that you can take on. And they're usually the smaller jobs. It may come that at some point in your career, you want to expand and take larger projects, which usually require more capital, more money. So let's look at some of the sources that you might look into as far as getting that money, assuming you don't have a rich relative or get lucky in the lottery. You might have to look to the bank for the three main kinds of loans that are possible. First of all, there's the note, a very common type of loan that's taken out for a very short time, usually 30, 60, or 90 days. You approach the bank and you tell them that you need $10,000 for 30 days. This note comes with your promise to pay it back at the end of that period with interest, and thus you've got yourself a note, a promissory note. Just think of a note as being a short statement. You may also decide to buy a new truck and new equipment, which means you're going to need to take out a loan for more than 30, 60, or 90 days, in which case you're looking at a longer loan that will be taken out for at least 1 year and maybe up to 7 years. These loans are called intermediate loans. They're not short, they're not long, they're in between and are very common in construction. The last loan, obviously, is the long-term loan, which you will take out for a very large loan to either buy property or a building in which to operate your business. In either case, you'll need a lot of money and you look to the bank for a mortgage. Therefore, borrowing money is one of the easier methods of getting capital. You might also look to the Small Business Administration as a source of loans. The other method of obtaining capital, which is not as well known, is called equity funding. Now, this word equity may be new to you, but if you dissect the word, you'll understand where this comes from. First of all, let's identify the word equity. Equity is another word for ownership. What you are doing when you use equity funding is that you are funding your company through the sale of equity or the sale of ownership in your company. So let's take a look at the next slide titled Types of Businesses and Equity. You will want to take some notes on this. You'll see that there are three main types of businesses that can be formed in California. First, there's the sole ownership type where you own 100% equity in the company. This is the most common method of operating a construction business in California. Secondly is the partnership type of business. There tends to be very few partnerships, and it's not recommended in most cases. If you've ever been in a partnership, you know the problems that can be encountered. If you do form a partnership, our advice is to get the partnership in writing, in which case you can lose a certain percentage of your business, say 50%, which means you lose 50% of the equity of the company to your partner who now owns 50% of the company. You own the other 50% of the company. Of course, the percentage may vary depending on the amount of money each of you puts into the company. The advantage, of course, is that you now have two sources of investment capital. You have two sources of capital being transferred into your company. Lastly, we have the corporation. You may be incorporated with only yourself as the sole stockholder. In addition, you might find many investors to put money into the company. Assuming you find 3 other investors, You end up with 2 more additional sources of capital. On the other hand, your proportion of ownership will decrease. So by selling the equity in your company or the ownership in your company, you have obtained more capital but have lost more control. You must consider the consequences when you decide to use this method to come up with money for your business. There are many advantages to incorporating your business, by yourself or with others. The most important of those advantages is that you are creating a separate entity that has a life of its own. For example, a corporation can be sued or go bankrupt without usually affecting the owners of the corporation, making these types of business models very popular for contractors. Of course, there are other positive advantages as well, such as being able to obtain corporate credit. If you would like more information on incorporating, our staff can assist you with that. We highly recommend incorporation as the best way for contractors to do business in the state of California. Track 6. Let's turn to the slide titled The Balance Sheet. We recommend you get an accountant or at least a bookkeeper for your business as soon as possible. For very little investment, it will allow you more time to do your trade. Just the advice of a professional alone is worth it to you and your business. More importantly, they will be preparing vital statements for you, which are called the financial statements. There are 2 basic financial statements we would like to go over with you. One is the balance sheet, and the other is the income statement. Now, first of all, let's look at the balance sheet. Take a piece of paper and divide it into 3 parts. Draw a line dividing the page in half. And then take the right side of that half of the page and divide that half into half. A balance sheet is made up of 3 parts. I want you to think of the balance sheet as a physical, a medical physical. You see a doctor once a year or so for a medical checkup. The medical checkup that is done for a business is called the balance sheet. You might think it's a lot of BS, but it is very important in knowing what is happening in your company. Think of it as a medical report. You see that doctor once a year because you need to know what shape your body is in, what shape your health is in. It's the same thing for a living business. For it to live, succeed, and be successful, you have to know what state it is in. So you have these medical checkups periodically. Many companies do balance sheets once a year, at the end of the year. Balance sheets are always dated. If you are on the calendar year, this is usually done December 31st. These days, with computers and easy-to-use accounting software, it is possible to see a balance sheet at almost any time. Accountants can generate these monthly and tell you every month what shape your business is in. There is an easy way to remember what is contained in a balance sheet, and we'll identify it as ALE. That spells ale. This report will tell you whether or not you are ailing. The A stands for assets. The L stands for liabilities. The E stands for equity. And we've already talked about equity, so we know that it means ownership. The E section, or equity, is the most important part of the balance sheet. It indicates to you how much of this business you own, and that is important, especially if you are to wake up one morning and find that you no longer own a business because you have not done a physical or balance sheet and you have not gotten any of these reports. As with any medical report, there's always good news and bad news. Remember, the doctor always tells you the good news first. So assets, the A part, are the good news that happens to a business. It's the assets that accumulate. It's the money that you earn. And it's the possessions of the company. The bad news, of course, is that to buy all these assets and obtain money, you may need to borrow it. So the liabilities, the L part, represent the bad news. It's what you have had to borrow, and it's what you will owe. Remember, in running any business, there are two sources of money, or capital. You either have it, or earn it, or you depend on others and borrow it. So the assets will represent you, and the liabilities will represent the other people you will use to obtain money. With these two sources of capital, you will acquire assets, or as some people call them, toys. And of course, keep in mind that usually it's the person who obtains the most toys who wins. So let's take a look at the slide titled The Balance Sheet. You will see a balance sheet for the fiscal year ending June 30th. Now, if you don't use the calendar year, which ends December 31st, you can pick any fiscal year period that you would like. So here we pick the fiscal year starting July 1, ending June 30th. In this case, we are assuming this company used a fiscal year starting July 1 and ending June 30th. Okay, let's do a typical balance sheet, a real simple one, so that you can understand the basic concepts. Let's assume that the only thing that you owned was an automobile. You would list that here on the left side of the balance sheet, showing that you had a fixed asset of an automobile worth $10,000. You just bought it, so you know it's worth $10,000 as of the moment on June 30th. Let's assume you have no cash. I'm sure that sounds familiar to many of you. So you'd have no current assets. You have one fixed asset. Your assets are things that you own that have value. There are two types of things that you have that have value. Either you have cash or you have possessions. In this case here, your possession would be the automobile. You just purchased it and it's worth $10,000. So the total of your assets in this case would be $10,000. Now, where did you get the money to buy this toy? There are two possibilities. Either you borrowed the money, in this case through a creditor. You might want to write that in your notes, the word creditor. In this case, the creditor is the bank where you borrowed $6,000. The other source of this capital, or money, that you used to buy the car was from you, your own savings. Your own capital, which you took out of your own pocket as a down payment of $4,000. Therefore, you were able to buy this car. Your $4,000 plus $6,000 you borrowed from the bank gave you a total of $10,000. $10,000 worth of liabilities and equity. Equity being the capital that you invested, and liability being the amount that you borrowed from the bank. Together, you were able to come up with $10,000 to buy this car. You can see your balance sheet balances. The left side totals $10,000 and the right side totals $10,000. Track 7. Turning to our next slide titled Depreciation, let's talk about depreciation. The word depreciation may be new to you. Without a business, there are fewer things that you can write off on your income tax. If you are in business for yourself, depreciation is an expense you can write off on your income taxes. Write-offs are amounts the government allows you to declare on your income tax which reduce how much you end up paying. Depreciation is an expense with a business, and any expense in a business is a write-off on your income tax. This is one of the advantages of having your own business. In the example with the car, depreciation is an expense because it is a loss of money. You buy a new car, a fixed asset, and it decreases in value the moment you drive it from the dealer. As many of you know, it depreciates 5 to 15% the moment you leave the dealer. There are two reasons why a car decreases in value. Number one, it gets worn out. And the other reason is it gets old. So how do you account for this loss of money if you own a business? The easiest method of depreciating any fixed asset is what we call the straight line method of depreciation. You first begin with the original value of your car or truck that you have placed into your business. It also could be a piece of equipment. You then decide how long you plan to keep that particular item, let's say 10 years. We believe both state and federal guidelines state that you can depreciate a truck or car for 5 years, but always check with your local authorities first. Let's use 10 years to make this example simple. You then decide what is the value at the end of this period of time. Let's say that you believe you will be able to salvage this new car that you bought for $10,000 and sell it for $400 at the end of its useful life. How much money did you lose over that 10-year period? You bought it for $10,000 and you sold it for $400. Therefore, you lost $9,600. That's a $9,600 expense. A very common expense in business and a write-off on your income taxes. The way you figure straight line depreciation is that you take this amount of money that you lost, $9,600, and you divide it by the number of years you plan to depreciate it. In this case, we're using 10 years. By taking $9,600 and dividing it by 10, we find that you get a $960 write-off each year for the next 10 years. That's $960 you can write off on your business income taxes at the end of the year, and you can do that for 10 years. The one big disadvantage of picking this method is that you are stuck with it. If you tell the government that you are using straight line depreciation, you can take a $960 write-off the first year, and you can only take $960 the second year, and so forth. You cannot increase or decrease it until you get rid of the car. If you estimate this figure incorrectly, and let's say you sell the car for $1,400 and you've written off $9,600, you have to report that $1,000 as income on your taxes. The straight line depreciating method is a very common form of depreciating, but you should always check with your accountant to see which method of depreciation is best for you at any given time. Because once you choose your method of depreciation, you have to stick with it, and you can't move to any other method further down the line. Another example of depreciation is called the double declining method. You will find this on the right side of the slide titled Depreciation. In this example of the double declining method, you can take 20% write-off the first year. 20% of $10,000 would be a $2,000 write-off. Right away you can see the advantage of using this method. It allows you to take $2,000 the first year compared to the $960 that you had in the former situation. But notice the second year how much it drops. 20% of the balance in this case, $8,000, would give you a write-off of $1,600 in the second year. So you notice it keeps dropping or declining and decreasing over the years that you hold it. probably the 10th year, you might write off $50. But it still averages out. It still totals $9,600. The advantage of the double declining method is that you are able to take a large chunk the first year, and that might be an advantage to you when you're starting out with business, when you'll want a large write-off. If you start any of these methods of depreciating, such as the double declining method, you can always revert back and go to the straight line. In other words, if halfway through this double declining balance you would like to switch to the straight line depreciation, there's no problem. Remember, you can always go straight, but once you're on the straight path, you must stay on the straight path, and you must not deviate from it. Track 8. Turn now to the slide titled The Balance Sheet 1 Year Later. Now, let's see what happens to our balance sheet when we enter depreciation 1 year after we purchased our brand new car. The only thing that is affected, as you can see, is that instead of having a $10,000 automobile now, you now have a car that is worth $9,040. You can see that it has depreciated $960, and that is where you indicate it, right on the balance sheet, right next to the fixed assets. Now we have total assets of $9,040. Let's take a look at the right-hand side of the balance sheet, and we see that the bank is owed $5,000, which means the equity in the car is $4,040. If you then add the liability to the equity, notice that the total of $9,040 agrees with the total assets of $9,040. Again, the balance sheet balances. Let's review that one more time. We have a car worth $9,040. $5,000 of that belongs to the bank, and $4,040 belongs to you. Together, you both own the automobile. Of course, that's until you miss a few payments, and then we find out who really owns the automobile. But until that time happens, this is the way it should appear on the balance sheet. This is showing you that you own $4,040 of your $9,000 car. In a business, this equity or capital that you have invested in the company is important, and that percentage is important. So this is the key point to the balance sheet. It is a medical report. It tells you how vital, how strong, and how prosperous your company is. If you had a $9,000 car and you owed the bank $9,000, your equity would be zero. You would have no business. And you'd have no car in that case. Track 9. On the next slide, titled Typical Construction Company, you will find the assets for Typical Construction Company. This may be the very exact balance sheet that will be on the state exam. They may change the numbers, but the idea will be the same. It will be in the same format, so take a good look at this balance sheet. It is very important that you study it, know how to read it, and know how to interpret it. Notice that this is just the asset side of the balance sheet. All we've done is taken this portion of Typical Construction Company's balance sheet and blown it up. This could be your company. Matter of fact, let's assume it is your company. In a company, remember, you have two kinds of assets. You either have current assets or you have fixed assets. Remember that the fixed assets are your toys, your property and possessions. The current assets would be your cash accounts. So let's find out how this divides up on Typical's balance sheet. Now let's take a close look at the left section, where we will find the current assets on top, and under the current assets will be the fixed assets. Let's assume this is your company. Notice on the right side of this slide, there are two columns. One is for the current year figures, and the other is the prior year figures. It's like comparing what your company looked like last year to what it looks like this year. And you'll want to make that comparison from time to time, especially from year to year. You will want to know how you compare last year at this time to this year at this time. It will tell you a great deal about where you are going. Let's just look at the current year figures, and we'll assume that you can read the prior year figures just as easily. Let's deal first with the current assets. Remember, what are current assets? Current assets are cash accounts. So all of the items we are going to list here are either cash or they will become cash. It's money we can rely on. It's money coming in the front door of your business. Where is this money coming from? We first start off with the cash account. Now, you can always remember what account current assets are, because if you look at any balance sheet, you'll notice that the first item tells you what current assets are. They are cash. And this is the amount of cash that you have on hand as of the day the balance sheet was prepared. When this balance sheet was prepared at the end of the year, this company had $10,000 worth of assets, worth of cash on hand. Secondly, they had $40,000 in retentions. Now let's talk about retentions for a moment. A retention represents money that you have earned, but a customer has retained. Customers usually retain 10% of each contract that you have performed for them. They hold this money until the job is complete and the lien period has passed, after which you will receive that final 10%. This final payment is called retention. In this particular case, this company has $40,000 worth of outstanding retentions. You've completed $40,000 worth of work, but you have not been paid the amount of money. But when you receive that $40,000 at the end of the lien period, you will deposit that into a cash account. Now you may begin to wonder at this point, who is going to keep track of all these transactions? And that's where a good bookkeeper comes in. We suggest that you get one as soon as possible, unless you want to spend all of your time in the office trying to keep track of all these balances and all these different accounts. Trust us, that's quite a job. The next account is what we call accounts receivable. Remember, this is an account where you're going to be receiving money. In this case, if you are in business, where do you receive your money? You receive it from customers. So, typical construction company has earned $70,000 as of this date, but they have not yet been paid. It is an account receivable. It is a very important account, an account you must keep track of. This represents a large sum of money. In this case, you have $70,000 you must collect. You must keep accurate records to make sure you can collect it. The customer may not be very willing to pay this money. You may have to pursue it. Many companies go out of business because they are unable to collect their accounts receivable. Can you imagine having $70,000 outstanding, especially when your creditors are demanding payment of your bills? That $70,000 represents a lot of money. So be sure to keep an eye on your receivables account. You may have to hire a collection agency to collect that money, but you must go after that money. It is vital to your business that you have this flow of money coming into your business. Otherwise, you'll stand still. Let's look now at the next account. The next account is what we call an inventory account. Inventory is comprised of those fixtures, supplies, and materials that you have purchased with the intention of reselling them for profit. You do not buy these things to hold on to them. They are only purchased in order to sell, in order to get more money coming in. In most cases, you take these supplies and fixtures and mark them up. So it means income. In this particular case, typical construction company had $200,000 worth of inventory. They have already taken $120,000 worth of that inventory and have put it into a building, into the project. So now they have billed the customer for it at this point. It has now either become a receivable or is the retention that we spoke about earlier. This leaves them with $80,000 worth of inventory that is still in their possession, and until they put it into the building, that $80,000 worth of inventory represents money tied up by the contractor. In addition to that $80,000, they probably have another $30,000 stored away somewhere in a garage. Adding those two together, we find that typical construction company has $110,000 tied up in inventory. Because this is a very high figure, it is always recommended that inventory be kept at the lowest possible level. You do not want all of your money tied up in nails, even if they happen to have been on sale. What good is having a lot of nails if you can't find a market or a customer or a project to put them into? They will stay in your possession, sometimes for years, without getting rid of them. Your goal when you run a business is to get rid of inventory. You want to achieve a quick turnover. Get it sold so that you can turn it into cash, as you will need this money for your business. The last account is an oddball account. It's called the prepaid expense account. Expenses, you would think, would be a liability, but when you prepay them, it becomes a temporary asset. It is money that you have prepaid in advance, and until you use that service, that money is actually yours. If you were to drop or cancel that service, or drop or cancel that insurance, for example, you would get that money back. Therefore, we can count that as a current asset. So now we're ready to total the current assets. There are 5 accounts which will total $250,000. That's $250,000 worth of total current assets. Now we'll begin to talk about the property and possessions the company has accumulated. This particular company has acquired leasehold improvements, vehicles, office furniture, small tools, and equipment. The original purchase price of all these, if you were to add them up, is $170,000. Obviously, these assets are still not worth $170,000. They have depreciated. They have depreciated by $20,000, which makes them worth today $150,000. Now we're ready to add up the totals, the total of current assets and the total of fixed assets or property and possessions. We have our current assets of $250,000. We have our fixed assets of $150,000. And that gives you total assets of $400,000. As compared to last year, you had $350,000 worth of assets. Each time you get a balance sheet, you should look at this figure. You want to know how many assets and properties and possession you have collected. You want to know how you are growing and if you are growing. In this particular case, if you had $350,000 worth of assets last year, and you have $400,000 worth of assets this year, you know that you are going in the right direction. You are accumulating assets and you are growing, and that's a good sign. But it's not complete in itself. Track 10. Let's continue to look at the slide titled Typical Construction Company Balance Right Side and find out where this $400,000 came from. Again, let's assume this is your company. Notice the label on this side. It says Liabilities and Equity. This page is divided into two parts. The top portion will be the liability section, comprised of the total current liabilities first, then the long-term liabilities, and finally your total liabilities. So, of the $400,000 worth of assets that you have, $280,000 came from other people, creditors. All of these people represent creditors. If you were to sell your company, or if you were to go bankrupt, you would need to sell all of your assets to pay off your creditors first. If you sold this company at this particular point in time, you would still have $120,000 of your own. This is your net worth, or total equity. This is the equity you have in the company. Let's go through the liabilities and find out where we owe money. These are all typical accounts for contractors. These are all accounts that you will need to keep in mind as a contractor. First of all, we have current liabilities. Current liabilities are debts that you take out for a short time with the purpose of paying the creditors back in a short period of time. The first account is the accounts payable account. For a construction company, accounts payable would be comprised of subs, suppliers, and people of that sort. People that are important to the existence of your business and without which you would probably not have a business. This figure represents the money you need to pay as soon as possible. You cannot allow your suppliers and your subcontractors to go months or years without paying them. Secondly, there are notes payable. The notes payable accounts, remember, is based on a note that is a short-term loan from the bank. In this case, this particular company has taken out $25,000 from a bank in order to run the business. Thirdly, we have accrued expenses payable. What kind of expenses are we talking about here? We're talking about the electrical bill, the phone bill, the advertising bills, and all the other bills that come in on a daily basis and must be paid on a weekly or monthly basis. The next account is payroll. In this particular case, we have a $20,000 figure that needs to be paid to the employees who are an important aspect of this business as well. On the date of this balance sheet, the employees had worked a few days and had earned this money, and on payday they will be paid. Who else now do you owe money to? When you run a business, there is always the government. In this case, the government gets two lines, $5,000 plus $30,000. If you were asked for the total tax liability for this company, your answer would be $35,000. So now we're ready to total up these 6 accounts and find that the total current liabilities are $180,000. The next liability we will discuss is the long-term liability account. This was probably a bank loan that was taken out to buy the truck and equipment. This $100,000 loan is not crucial because you have years to pay it back. So now we take the total long-term liabilities and your total current liabilities, adding them together, and you find out that your total liabilities are $280,000. Now let's recap what we've done so far. We found that we had $250,000 worth of cash. We had $150,000 worth of fixed assets for a total of $400,000 in assets, $280,000 of which came from creditors. So how much did we come up with on our own? The solution is to take the $400,000, subtract the $280,000, and you find the equity in the company is $120,000. If you add the $120,000 to the $280,000, the result should equal $400,000. And thus we have a balanced sheet. $400,000 equals $400,000. Now let's find out where this company came up with the $120,000 in equity. This company happens to be a corporation. When you set up a corporation, you are setting up a company that has a life of its own. This company can be sued. This company can be taxed by the government as if it were an individual. This company can go bankrupt. Notice that I did not say any individuals were sued or any individuals went bankrupt. It's something that only happens to the corporation. That's the only type of company that you can establish that has a life of its own. It will live beyond the life of the people who work for it, and everybody who works for the corporation is considered an employee, and employee benefits. Employee benefits, that could be your benefits. Now, let's get back to this particular corporation called Typical Construction Company, Incorporated. We find that this particular corporation sold stock. Initially, when they started this business, they issued 10,000 shares of stock. They found 10,000 individuals to invest in this company, each buying one share of the business or the equity of the company. In return for this piece of paper that they have received, these individuals invested $5, let's say. So this company was able to come up with $50,000 worth of assets or capital to get started. Notice the $50,000 figure. Once that $50,000 has been invested, it stays in the company. The company may never give this back. These people have gambled that this company or corporation will be successful, will make a profit, and then the stockholders or shareholders in this company will get a piece of that action. Since they are a part owner of the company, depending on how many shares they own in the corporation, they will get dividends based on the profit on a quarterly basis. They will get a share of the profit this company makes. If this company wishes to sell more shares, it can raise additional capital, which we discussed at the very beginning of this presentation. If you want to increase your capital, you can sell equity in your company. You can sell shares, share ownership. Secondly, if this company makes a profit, the board of directors, which could be solely one person, may decide to retain some of this profit in the company. They're not going to give it all back to the stockholders because the company may need the money to expand. Part of the profit may be kept in the company. This is called retained earnings. In other words, this company is earning money and is going to retain some of those earnings. This way, they can take some of that money and go out and buy additional assets and give the rest of it back to the shareholders, stockholders, in the form of dividends. So there are two ways to come up with more capital. Just to reiterate, you can either sell equity in your company or borrow the money, or you can earn it the hard way. You can work for it. Taking these two sources of capital, the original investment or capital plus the retained earnings, we come up with $120,000. This company has equity in the company worth $120,000. If they went out of business today, they would still have this $120,000. This company is worth $120,000. When you operate a business, you will want to keep track of how much your company is worth, how much of it you own, as opposed to how much other people own. Next, we're going to take a look at the income part of the financial statements. But before we do that, let's review what we just finished talking about as far as the balance sheet is concerned. The balance sheet is a medical report. It tells you what kind of financial situation your company is in. To arrive at the figures on a balance sheet, your doctor, that is, your accountant, threw these figures together to show you what shape your company is in. Track 11. Now we're going to turn to a different kind of financial statement. And that statement is the income statement. If you take a look at your slide titled The Income Statement, you'll see a very simple income statement. What is an income statement? An income statement shows profit or loss for a period of time. Now that period of time can be a month, it can be a quarter, it can be a whole year. What you want to do is bring together figures that show whether you made a profit or whether you lost money for that period of time. Accountants and bookkeepers can supply you with an income statement every month, so you can determine if you're making a profit. And if you're not, you can begin to correct that situation. On the very top of these income statement reports, you will find the total amount of business you have done for that period of time. This is called net sales. In other words, how many sales did you make for that period of time? Now, we will assume this report is for 1 year. So we are looking at an income statement where this company took in $1,250,000. Hopefully in your first year, that would be a nice figure to make, wouldn't it? Remember, this figure represents money that has come into the company. It was money that was collected from customers, business that was done, sales that were made. The next step is to subtract any expenses which have been incurred by the business to produce that amount of sales. In this particular company, we see $1,145,000 worth of expenses. If you subtract the expenses from the net sales, you will find that this company made an operating profit of $105,000. This figure is very important. It's like a report card. If this were your company, it tells you whether you operated the company at a profit or not. You have a lot of control over whether your company makes a profit when you consider the number of sales you make, the amount of money you collect, and the amount of money you spend. Obviously, the goal is to spend less than you take in, or take in more than you spend. In this particular case, the report card shows that this company did a good job. $105,000 worth of good work. The company operated at a profit. That is why these figures are called operating profit. The next step is to send your report card, of course, to the U.S. government. The IRS will take a look at it and send you a tax bill for $30,000, which is your reward for doing such a great job. When you subtract the $30,000 from your operating profit, you find out how much money really ends up in your pocket. I want you to think of this net profit as the net being your pockets. Every time you hear the word net, visualize your pockets. It represents the money that goes into them. It's what they call the bottom line. In this particular case, this company ended up with $75,000 in their pockets. Money that was clearly theirs, after all obligations and liabilities had been paid. An income statement can also be called an income and expense statement because that is what it shows. It shows your income and your expenses. Those are the two major components in this statement. This statement is also called a profit and loss statement because at the bottom it will show whether you made a profit or a loss for that period of time. Accountants like to abbreviate profit and loss as a P&L statement. So now we have three names for this report. It can be called an income statement, or an income and expense statement, or a profit and loss statement. They all refer to the same group of figures that are brought together to determine whether you made a profit or ran at a loss. Now remember, these income statements can be done monthly, quarterly, or yearly. The government requires them quarterly and yearly because that's how taxes are figured and paid. Each quarter, some companies must report this figure, this operating profit figure, to the government and pay a certain proportion in taxes called quarterly taxes. Track 12. Bring your attention now to the slide titled Typical Construction Company Income Statement, where you will find the income statement for typical construction company. Now this is very similar to the income statement we just reviewed, except that it is more detailed. Notice that this is income statement for the full year. Apparently this company is just about ready to close out the year and pay their income tax at the end of the calendar year. So they will show the government how much money they have made. You will see that there are two columns, current year figures as opposed to prior year figures. When you have your company, you will want to know and compare what you did last year compared to this year. Are you making more profit than you did last year? Are you operating the company better this year than you did last year? These are all important things to know. Let's look now at the income statement for typical construction company and deal just with the current year figures. You will see that this company took in $1,250,000 worth of net sales. Now let's see where that money went. We find that this particular income statement contains very broad categories, showing that the expenses were divided into three major categories. The first category is called the cost of residences sold, or the cost of sales. This would be the cost of doing this amount of business. Now think about it. In the last job that you worked on, what were some of the costs involved in doing the kind of work that you do? Obviously, it takes labor and material to do the work that you do. You will find that these are the major expenses and are considered as one group together, the major expenses. In this case, the largest amount. Over $1 million was spent on labor and materials. Everything else is considered overhead. Now, overhead is that figure, or those amounts, that it takes to run a business on a day-to-day basis, even if no jobs are being done. For example, it takes money to open your doors every morning. It takes electricity. It takes paying the phone bill. It takes paying the rent. All of those things are considered overhead. This particular income statement breaks down the overhead into two categories, general and administrative expenses. Administrative expenses would be things like your salary, your staff's salary. Everything else can be considered general operating expenses. These would be operating expenses such as insurance, telephone, office supplies, and things of that nature. Now, we add these three major types of expenses together to find out what the total operating expenses for this particular company were. We now take this figure and subtract it from the net sales to find out whether this company operated at a profit. And we see here that they did. We find that they operated the company at a $105,000 operating profit. You can arrive at this figure by subtracting the operating expenses from the net sales. This particular income statement shows this profit figure as income before provision for federal income taxes. In other words, before the government is paid. This is the amount that is reported to Uncle Sam. This is the company's report card, their operating profit. Lastly, we find that the tax liability is subtracted, leaving this company with a net, that is, in the pocket. a net profit at the bottom line showing a $75,000 net profit. That's the amount of money that ended up in their pocket. So remember, pockets are nets, net profit. Now, let's compare how this net profit compares to the previous year's net profit. You can see that they doubled or almost doubled their net profit from last year. This is obviously a good thing. It'll be a good sign when you can see in your company profit doubling in 1 year, or maybe doubling year after year. We hope this happens to you. Track 13. Now let's turn to the slide titled Cash Flow and review the very important topic of cash flow. Cash flow is vital to the existence of your business. In any business, you have a flow of cash. Picture yourself sitting in your office, and you can see all of this money you will be making as a licensed contractor coming in the front door. Money represents current assets, cash. In the slide titled Cash Flow, you can see we have a flow of cash. We'd like you to picture all of this money. It will help to get you enthused about becoming a licensed contractor as soon as possible. Now then, see on your desk, picture all the bills that need to be paid. Hopefully, you're going to have enough money coming in the front door so that it all doesn't go out the back door. If you do not have any money left over after paying your bills, you're not going anywhere. So let's take the current assets of $250,000 of typical construction company, which represents current assets. The $180,000 represents current liabilities. Let's see what kind of cash flow this company has. Already you can see a pretty good cash flow, can't you? Just think of it as a flow of liquid gold. If you take these two figures and subtract them, you will find that this company had $70,000 left over. That's good. Now, if you were in business right now and this was your company, you might be tempted to take that money and play with it or buy toys, cars, trucks. But when you are in business, you do not play with money. You take money very seriously. You take that money and you put it to work for you. Therefore, we call this leftover money working capital. In other words, you could put that money to work for you to make more money. You might take this $70,000 and buy another piece of equipment, or use the money to take on 2 more jobs and maybe hire more employees. What is this going to do? This is going to create more money coming into your front door. This is the purpose of being in business. It is to take the money coming in and make it work for you to bring in more money. So we call this leftover money net working capital. This is illustrated in the slide titled Net Working Capital, and it is a very important concept, so be sure you understand how to figure this out. Simply put, you get net working capital by taking your current assets, your cash coming in from customers, and subtracting that from your current liabilities, or your bills.